Probably bankers utilizing the green shoe. So especially with a deal like this. So you kind of use the shares. With the thing with it, when you do an IPO, you sell a bunch of shares and then banks can buy other shares at the IPO price. So typically the whole mechanism operates to basically give some form of balance with the deal. So I was talking to a few bankers away from the deal.
Sounds orchestrated to me.
It's orchestrated. I mean, don't ask Bill Ackman about it. He has some pretty strong thoughts on it. But I was talking to a banker away from the deal, and he was basically saying when you see a deal like this where so much of the book, as we've reported, has been allocated to a handful of investors, people will get jittery. So if you see the stock dropping and you're a hedge fund who bought this to make a quick buck, you want to get out as quick as you can. And then the banks will wait for that kind of rush of volume, help stabilize the price, and then that can set up for, down 2.5 to up 2.5, but still marginal.
Is that not normal to have, half of the book allocated to the 3 largest investors?
That is tighter than I can think of in recent memory. We normally will have some deals that they call them clubby, but as we reported, half the book to 3 investors, so $750 million of stock chopped up. And then if you look even further at our reporting, top 15 took 90% of the deal. So very tightly allocated to almost friends of Morgan Stanley, if you will.
All right, clubby, friends, all that good stuff. Having said that, Ryan, going into this, it was downsized. So we had reduced expectations going into it. Based on that, and we are now showing a little bit of a gain, is this a good debut, a bad debut, or neutral?
I think it's probably slightly, I don't want to be that person, but I think it is still slightly too early. Let's see where we are at 4, because I think, to the green shoot point, sure. But I was also talking to Michael Intrato this morning, the CEO of CoreWeave. And, he was quite quick to point out, aside, away from the noise that we've seen this week in markets and, just given where the NASDAQ is and the S&P is today, CoreWeave is not like most other tech companies that some of these investors, would be putting orders in for. I mean, his view is that it's quite capital intensive. And it is just based on the business model of CoreWeave. And so his view in telling me this morning on the phone was that investors are going to take some time to actually get their heads around how we do things. And, it's going to be a little bit of a process. So I think you could probably see some volatility for a period. And, we're at, 40.91 now. It is conspicuously in that $40 area, the price there.
Is that just CEO speak? To explain maybe some of the difficulties? Forgive
Ask
me.
him, Carol.
I don't know how should we, we're smart here at Bloomberg. How do we read that?
And, and I put that to him. And, I think there's a lot going on. I mean, you've obviously got the Microsoft headline this week, which we spoke about yesterday. But then at the same time,
their biggest customer.
It is, yeah, and you would have to imagine in there among that sort of taking 50% of the book too. I'm sure in and around that area. And I actually put to Michael Intrator this morning around sort of the Nvidia angle. And again, away from some of the noise, he said that without Nvidia and without the other 27 investors, this IPO wouldn't have got over the line.
Interesting.
Okay. So why did they do it then? Or is it because they knew they had those backstops?
I think, for a company like CoreWeave, the thesis is quite clear. It's just it's a valuation mechanism right now if you're an investor, because I think the free cash flow is very good. I mean, people are generally quite comfortable with the leverage, but it's always coming back to sort of some of the concerns around the customer concentration. And they're quite quick to point out that the OpenAI contract that they agreed quite recently, almost $12 billion is a boon, and it is, but at the same time you're still faced with 77% of your revenue on paper coming from essentially 2 customers. So regardless of what sector you're in, whether you're AI or otherwise, people are going to look at that and think, is that okay for us? And you take a view, right?
Yeah.
Bailey, even though this is a little bit different of an IPO, it's certainly a canary in the coal mine or some sort of bellwether for other companies that are on the sidelines right now thinking about going public. What's at stake here?
A lot, but also not a lot. Okay. So put it this way: the biggest
the liberal arts answer. I like it.
The biggest IPO of the year was Venture Global. Similar downsize, cut the book by about 40%, priced poorly, traded poorly, down north of 57%. When I talk to bankers and investors, they were vocal. This is a one-off. We're not worried about it. This deal comes out. Talking to bankers yesterday, we're not too worried about it. But it begs the question: when will people be worried about it? Because when you have 6 of the 10 largest U.S. IPOs year to date trading below offer, you can point to the market being down as much as you want. But at the end of the day, people buy IPOs to outperform the market.
Right.
If you're not getting a day one pop or even a month later outperformance, that starts to make people second guess, why am I going to allocate resources to a private company that I've maybe met once or twice when I can buy your direct peers at a discount? And that's kind of what's been playing out.
It also makes me wonder, at Bloomberg Invest this year, I talked with the president of the New York Stock Exchange, Len Martin, and the expectations were that this was going to be a better year for M&A, for IPOs. Highly anticipated was CoreWeave and some others that were substantial in terms of their size. So I'm just kind of wondering, is there something systemic going on in the IPO market? Or is it just, once again, because, right, give us some context in terms of the last few years.
So we're entering now the fourth year of very lackluster IPO offerings.
Right.
So ever since the market really got shut, late 2021, early 2022, you've had dribs and drabs. ARM has been terrific. Reddit has performed, outside of the pullback, all things considered, quite well. But when we've had 3 years of bankers and CEOs pointing towards the market not being there, even though we're at all-time highs, now you're dealing with a market pulling back, a number of companies, early investors maybe saying, hey, we penciled in 2025. We need to get this puck on the ice. And when Bloomberg Invest was playing out, the VIX was back above 20. We're back above 20 again. That's where people on the banking side look at as okay, maybe we should rethink this, or we need to be more diligent with how we price these deals and how we communicate to investors. But there's, as you mentioned, since March 14th, the market's been choppy. Klarna, StubHub, eToro, and Integrity Insurance have all flipped public. So they've opened the door to going public.
But go ahead, Ryan. I know
I
you're
was
going
just going
to
to jump in and say, I think it points to a wider question that's going on between investors, large, tier one investors in the banks around, what is the true quality of most companies trying to go public these days, and how much of a discount is necessary to get them over the line. I mean, we've talked a lot about, I think, on the desk, certainly around the nature of the IPO discount. It has narrowed, in recent years, but is there an idea that it could start to widen again, given some of the price pressure that we're seeing in some of these debuts?
I also think about, this is something I know you guys cover and we talk about, Tim and I, the private markets, and just, again, there's so much cash out there. I mean, how old is CoreWeave? It's been around for...
I think
They're young.
2017.
It's a younger company. All right. Because we have seen a lot of companies that are able to stay private for a lot longer.
I mean, look at Klarna, right? We talked about that the other day.
Yeah,
I mean,
this
how
is
old
like a
it
company
is.
that's almost as old as Facebook.
Yeah.
It's wild.
Yeah. So it's kind of interesting. All right. So then what's the outlook? We got just about a minute or so left. I mean, Ryan, how are you thinking about this today and maybe what's to come? Or what are you hearing from
I mean,
Wall
I
Street?
think the point on private capital in general is a prescient one, because there is someone I was speaking to this morning who was away from this deal that we're talking about today, and they're kind of saying, our IPO is again being seen as sort of the last resort, as opposed to a sign of strength. And what does it mean for those who look to go? And Klarna could, in theory, go as soon as next week, but are they?
Well, Bailey, you mentioned all these companies that in the last few weeks have flipped to going public. How much can they actually delay just in the last 30 seconds that we have?
There's no rule. So technically you can be on file for as long as you want. You just pay lawyers. To Ryan's point, Klarna, the earliest they could launch a roadshow would be Monday. So
Okay.
that's what we'll be watching. But again, tariff day is next
Yeah.
week, and who knows what's going to go
Well,
on.
hopefully for your sake for the weekend, I hope that doesn't happen.
Get a
You guys
break.
some
Get a
time.
break,
Get a little
everybody.
break.